All right. So today we'll be discussing how to be secure and profitable with real estate notes. We have a great guest speaker. His name's Justin Bogard. Can't wait to tell you a little more about him. So a few things before we get started. We need to confess here at NewView, we are a third-party custodian. We are non-fiduciary. It is really up to you as the client to do your own due diligence to figure out if that is the correct type of investment or niche that you want to hold in a self-directed IRA. So if you want to learn more about due diligence, we have lots of guest speakers that come in and they will teach you exactly how to do due diligence on whatever type of asset you're looking to purchase. So always discuss your investments with your attorney, CPA, or whoever your financial advisor is. Those are your best resources, of course, to give you any type of tax advice or investment advice. A few more things about NewView Trust. NewView's been in business for 17 years. They were established in 2003. They are a full service public regulated trust company. Like I said, third-party custodian, and we are based outside of Orlando, Florida, in Longwood, Florida. That is a picture of our office here. We custody 1.5 billion under client assets. And a few other things about NewView that I take pride in is that we are simple to do business with. We're always available and we are responsive. You call us, you will get a live person. We do not like to leave anyone on hold for too long. And if you email us or did leave us a voicemail, well, we will get back to you that same day. Also, we get graded on our responsive time. We average 98% of the time that we will answer the phone with a live person. Not a lot of companies can do that nowadays. So we don't leave you on hold and you don't have those recordings that you're listening to constantly. So I'm gonna tell you a little more about our guest speaker today. His name is Justin Bogard. I had the pleasure of being on his live broadcast and it's called Be the Bank. If you haven't watched it, I definitely encourage you to watch it. It's a great resource to learn all about note investing. So Justin is the president of Bright Path Notes. He's also the co-host of a podcast, Two Wealth Show. It's a great podcast as well, a good resource to learn more about note investments. He's also the contributing author to a best-selling book. It is called Real Estate Without Renters. So without further ado, I am introducing Justin Bogard. Go ahead and take it away.
Thanks, Brian. I appreciate you guys having me on. Hey, everybody out there. I recognize a couple of names on your list there for attendees. Shout out to my buddy, Chris. Haven't seen you in a minute. We'll have to connect afterwards. But yeah, I'm Justin Bogard. My company's Bright Path Notes. Let me get my screen up for you guys. I'm a little slow today on Zoom. All right. Who's all been Zoomed to death this past year? I know I have been, right? I've actually switched to a different platform when we do our live events to a thing called StreamYard. If you guys are into podcasting and video casting, I would highly recommend you check that out. So today's topics are going to be focused on being secure and profitable with real estate notes. So we're taking the assumption that you guys have a good cursory knowledge of what real estate note investing is. And I'm here to kind of reiterate a couple different ways that you might invest in notes, and then also just kind of give you some tips and tricks and some things to avoid about that. So as Brian already alluded to, I'm the president and founder of my company, Bright Path Notes. I'm the host on the Two Wealth Show. It's a podcast, and the Be the Bank broadcast is our monthly free, we call it a meetup / broadcast that we do just to get the word out there about note investing. I'm also a contributing author to the Real Estate Without Renters book, as Brian had mentioned. Kevin Shortell, if you guys know who he is, he was the main author on that book. So there's my contact info out there, Justin at brightpathnotes.com, if you want to get a hold of me. The first thing we're going to talk about, I'm going to break this down to two things. We're going to be talking about owner financing, and we're going to be talking about purchasing performing loans. These both categories are going to be on performing loans. So in this example are going to be all retirement accounts. This happens to be in my self-directed Roth IRA. And I had a vacant lot, and I want to kind of show you what I did. And then we're going to back up and go through some of the details of this particular case study. So there's the self-directed IRA right there. And there is a buyer for this vacant land lot that I had in my self-directed Roth IRA. So I am on the deed as a self-directed Roth account. That is the owner of this piece of land. And this buyer wanted to buy it from me, but they didn't have enough cash to pay for the entire amount. So they gave me a down payment, which they gave me at closing. I transferred the deed over to them, and I secured this vacant lot with a promissory note and mortgage. Now, monthly payments are now coming to me, and I also get to keep that down payment. So this is all going to my self-directed Roth IRA. So every month they're just giving me a check. So this is where it is. It's actually in Florida. I believe it's Lehigh Acres, Florida. So there happen to be a lot of vacant lots around there. If you notice, there's a couple of houses that have been built. This little rectangle that I'm drawing here is about where the lot was, just to give you a frame of reference from this picture. This is obviously a Google view. You can see, looks like Walter White's RVs down there at the bottom corner. If those of you who watch Breaking Bad, you would get that joke. Otherwise, I'm sorry for the bad joke. So let's talk about this piece of land that I have and the challenges that I went through and how I solved those challenges by using owner financing. So we're going to focus on the collateral first. This was a developed piece of land in Florida. I think I bought this in 2016 in my self-directed Roth IRA. I was told this was going to be able to triple my money in the short time of 4 to 5 years. And that really wasn't the case, but that's what I was told back then. I was a little naive, right? There were a lot of empty lots in this area. I should have probably done some more due diligence before I bought this lot. And by the way, I fully funded this through my IRA with cash. I didn't use owner financing to buy this lot. This was all investment that way. So I thought to myself, I waited about a year or so when I had this lot. And I'm like, I just want to sell this and see what happens. So I had somebody drive down there. Of course, I live in Indianapolis, Indiana. So I'm very far away from this lot in Florida. And I had somebody stick a sign in the dirt, if I said yard, in the dirt, if you will. It says, for sale by owner, seller financing available, kept it real short and sweet. I got some phone calls, but nothing really turned over. There was a lot of local people there in Florida that wanted to buy the land and use it for, it seemed like they were using it to park their RV on the lot. And that's what a lot of people were doing with these empty lots. And so they wanted it for a pretty cheap price. I would say they probably were telling me they would pay $3,000 to $4,000 for this lot. I probably had about $5,500 in this, maybe $6,000. And I was looking to make a little bit more on it. So it didn't really work out that way. So a few more years went by and I said, there's got to be a better way to do this. Maybe I shouldn't sell the lot as a cash lump sum. Maybe I should sell it with owner financing. I mean, I do talk about it, right? So maybe I should act on it with my self-directed IRA. And truth be told, this was a small balance IRA that I had. And the truth be told, I kind of forgot about this account and this lot in there because I didn't focus on that every day with my retirement account. I was focusing on other things with my business. So this is kind of a lesson learned to make sure I do an evaluation of all my accounts and all my portfolios to make sure I can keep things moving. So I lost some momentum, but I used Facebook Marketplace to advertise for owner financing. And lo and behold, it did not take long. I want to say it took a couple of days to get several inquiries about my vacant piece of land in Lehigh Acres, Florida for owner financing. So I was looking for about $1,000 down. I was going to owner finance the rest of it. I think my next slide is going to tell us about the terms here. So let's advance to that. So I was asking about $7,500 for the purchase of this piece of land with owner financing available. I was asking for $1,000 down. And so I would carry back the $6,500 as owner financing. I did this with 11% interest rate over 4 years. So this is a high interest rate loan over a short period of time. So I think the principal payment was around $170 is what I am receiving right now. The documentation was important. So the documentation I used, I didn't want to do a land contract. I wanted to do a note and mortgage. I didn't want to be on the deed. So I chose to do a promissory note and mortgage. I got an owner's policy, obviously, to transfer over to the new buyer so that they would have a clean and clear with no encumbrances on the deed. I got a lender's policy as well to ensure that I was in the first position because I knew that I was going to trade that paper. We can talk about that in a minute. And I closed at a title company, right? I took all the right steps and measures to make sure that I had a very strong and secure position on this land. And so if I had to take it back, I could take it back. I had to make sure the loan was serviced by a third-party servicer. We call them a professional loan servicer. So that's kind of what happened in that situation. And I actually recently sold that piece of paper and I ended up coming out a little bit ahead on this deal after all. So I bought it. I thought I was going to lose money on it. I sat on it for a while. I turned to owner financing. I definitely found plenty of buyers for it. Somebody gave me a down payment. I got some cash flow in between for probably six to 7 months. And now I have sold that paper to another investor that wants to collect the cash flow. So it turned out to be a pretty nice little deal for me in my IRA. And now I can redeploy that to another opportunity. The second situation we're going to talk about is just buying a performing loan, like someone just bought the performing loan that I had when I created the owner financing. So in this situation, we're going to give you the visual again, then we're going to back up a step and break down the numbers of the specific deal. So we have a homeowner who purchased a home and they got some financing for it. So they're on the deed, right? And the bank has secured that home with a note and mortgage. Again, another self-directed IRA Roth account that we have, we end up purchasing this note in. So we simply gave the current owner of the note money to purchase that promissory note and mortgage. So now that homeowner is going to pay my self-directed IRA every month. So that's going to come in, and it's a Roth account if I didn't mention that already. So it's all going to be money that I don't have to pay taxes on in the future. So this is the house. It's just in a blue collar area, working class area. It happened to have a pretty good looking asset, in my opinion. I saw the grass, it looked like it was well kept. I didn't really see any damage on the house. The roof had some nice color to it. It didn't appear to have any damages to it. So I said, this looks like a nice piece of collateral. This happened to be in, I believe, Dayton, Ohio. It's a 3-bedroom, 1 bath. It actually was sitting on 2 lots. So it was, what you didn't see was behind the house was an extra lot that was added to the deed. So this is what's cool about doing your due diligence and looking at your homework, is that I found more value in this asset because it was actually had another lot attached to it. So this, I got a bonus here that maybe other people didn't see when they were looking at this loan. It showed a lot of pride of ownership with that piece of collateral. So I felt good that the borrower had a very high vested interest of staying in this long-term and keeping the property up. It was in a low crime area. We always check the crime in the area before we buy. And so we didn't feel like there was high risk of any vandalism, theft, or, God forbid, any really violent crimes. The terms on this deal were really good in our favor as the one purchasing the note. So the original note balance was about $41,000. The rate on this note was a very high rate. It's a 9.99% interest rate. So the payments coming in were about $395. I rounded this to a few pennies for those of you that are running a financial calculator in the background. Okay. The current unpaid balance when we purchased this loan was right around $29,100. We purchased this for about $25,000. So we were able to negotiate the price down and get this for a pretty sweet little deal. The pay history is what really piqued our interest in this particular note. It had been paying since 2011. So that's a really long pay history. I believe we bought this note last year. So it had been about 9 to 10 years of paying. Not only having a long pay history, but they were on-time payments, just like clockwork. Every month on time, getting their payment about the same time every month. They also paid a little extra every month as well, which was even an added bonus. You can tell they were very heavily incentivized to get this loan paid off so they could own this free and clear for themselves. There's actually 3 borrowers on this loan as well, which is kind of odd. Typically, you'll see 1 to 2 borrowers. Very rarely will you actually see 3 borrowers on it. So I felt like there was 3 people signed the promissory note. That's a lot of income coming in for this little house. And so I felt like this was a very, very unique situation, and we want to take advantage of it. By the way, those of you that do have questions for me about these particular case studies, we are going to stop here in just a little bit, and we can really dive into the Q&A. We just kind of wanted to get through the entire presentation first, and then we can definitely dive specifically into some details on these deals or about note investing in general. I'm happy to answer any questions. So that's kind of the rundown on these 2 little scenarios that we have. These are both done in a self-directed IRA Roth. You can do these in any account that NewView Trust would have to offer. I know they have 401k type of accounts and traditional accounts as well. So what I want to make sure you guys take away from this as well is the best practices when I've been doing these loans, when I'm buying them or when I'm creating them. And I want to give you some making some really good compliant loans. This is some great free advice that you should definitely write this information down. You want to use a third-party underwriter for your borrower. That first deal that I did with owner financing, I didn't have to send them through underwriting because it wasn't really an owner-occupied loan, and it was a very small balance loan. So there wasn't a lot of risk to me there. But in general, you do want to use third-party underwriting for your borrower, because you want to make sure they have a really solid debt-to-income ratio So they have a high ability to repay this debt. Otherwise, you're going to be starting all over and you're going to have to foreclose. You're going to have to get them out of the house somehow and get somebody else in there that can pay you on a consistent basis. Trust me, underwriting is crucial. And not only the Dodd-Frank and CFPB rules are also getting you to do that as well to make sure you have a compliant loan. Securing your loan with real estate, obviously, which is what we're talking about today, and using the instruments called a mortgage or a deed of trust, depending on what state you're in. There are land contracts, there are contract for deeds, agreement for deeds, contract sales that people do use, but we tell you that the most security that you can have and the least amount of headache that you're going to have starting from the beginning when you're creating a loan is always using a note and mortgage and or a note and deed of trust, depending on what state you're in. Always go for that first. There is a time and a place for land contracts and contract for deeds, and we do have case studies that we've done before like that. But just remember, a note and mortgage and deed of trust is the preferred way to go. Getting a lender's policy, you might not have done this before, but this is something that you should do. A lender's policy can carry to the next note owner, to the next note owner, to the next note owner after that. And it's really good. It guarantees the position. We typically invest in senior liens or first position notes. And that's what we would want you to prove and verify, that you have the first position, right? So lender's policy is important. And then finally, the last piece of advice I'm going to give you is collection through a professional loan servicer. We call them a loan servicer in general, but they are a licensed, bonded, insured company that specializes in collecting payments on debt for you on your behalf. They're very nominal as far as their monthly fees are concerned. It's typically between $20 to $40 a month, no matter if it's a $1,000 payment or a $200 payment a month. So it's very fair and very reasonable. They're collecting the principal and interest. They'll escrow for taxes, insurance if the loan calls for it, and they'll work out with the borrower and take the phone calls from the borrower. So this makes it a very set it and forget it mode, and this makes you really secure. If I'm buying a loan from somebody and they have it serviced through a professional servicer, I like that, and I'm willing to pay more for it. If the loan is being self-served, it's a little more challenging to prove what that unpaid balance is. And so that's the main reason why we want to do that. So that's the information that I want to give you. I'm getting ready to open it up for some Q&A here. But before I did, I wanted to make sure you guys had my information and were able to follow me, my company, Bright Path Notes. So like Brian mentioned before, we have a podcast called a Two Wealth Show. It's on every podcast directory. We actually do record the video of the podcast on the Bright Path Notes YouTube channel. Speaking of the Bright Path Notes YouTube channel, we stream live once a month our real estate note investing Be the Bank broadcast. And by the way, these things are all free. And it's on our YouTube channel, and we stream it on our Facebook page as well. We do it on the second Wednesday of the month. Brian happened to be on our episode last night, so you get to see Brian. You can watch the replay on it. And then the Real Estate Without Renters, we had a #1 bestseller on Amazon, and that is a book that you can find on Amazon. And I am one of the contributing authors on that book. It's a great book that talks about a lot of different real estate investing strategies. And don't forget, we do have social media and stuff. We got Facebook, Twitter, Instagram, and we obviously got our YouTube channel as well. And so, Brian, I'm ready to open up some Q&A because I know we got some questions out there stimulating.
All right, Justin, thank you so much for those case studies. I think you really put in perspective some great examples of what it's like to own notes, especially using a self-directed IRA.
Mm-hmm.
A lot of people listening, they are buying notes and they're using cash already. So they're not really understanding or seeing the impact and the difference versus, having in an IRA and building that wealth in a tax deferred or a tax-free vehicle like you can do in an IRA or a solo QRP type of plan. But anyone listening, if you guys have questions, go ahead and type those in the Q&A section. We're going to go through those now. If you guys have, questions directly for Justin, more about like buying notes, or about his specific company and the notes that they deal with, you can email him at justin@brightpathnotes.com. That would be the best way to get information on that. But if you have general questions that he can answer just on notes or self-directed IRAs, I can answer. Go ahead and type those in the Q&A now, and we'll go ahead and get started with the Q&A.
Yeah.
All right, Justin, first question for you.
Sure.
Please give me an example of a third-party underwriter, and how do we find them?
That's a great question. And when you get into the note investing business, you realize that this isn't a job that's described and it's out there to where you can just click on something and find somebody very quickly, like a landscaper or a photographer, for example, right? You can probably find one of those people pretty quickly and probably more than a handful within an arm's reach of you. So if you've ever gotten a loan personally before, you go through a bank and the bank has their own underwriting department, right? There's a specific group of people that collect your information about your debt and your income, and they do an analysis. So what we're talking about when I say third party underwriter, they're not tied exactly to a specific bank or an organization. They're kind of a la carte or on their own. And how you find them is when you actually work with loan servicing companies, they have their own loan servicing, their own underwriting department within them, because they got licenses and qualifications to be able to do that in certain states, almost all states. So that's one place you can find them. Another place you can find them is a friend of ours, Russ O'Donnell, had started a organization in Phoenix where I believe he's able to underwrite in almost any state. I don't believe he's the owner anymore, but his company is called the Underwriter. And so I'm just giving my recommendation that I have used him before, and that is an underwriter that you can use as well. There are other underwriters that are maybe specific to Texas or certain states that I've heard of before, but if I can give you one advice, I know I've used Russ's company called the Underwriter before, and I've liked them. So I hope that answers your question.
Yeah. What about like real estate attorneys? Can they underwrite notes?
Well, they would have to have the actually, I might not say the acronym right, NMLS attachment and licensing to their and credentials to their name, and have to have gone through that process, if you will. So they are more like a mortgage broker's license. It's similar to that, but they have the ability to loan originate and underwrite a borrower because they have. Now, the reason why we say third party is because if you are trying to stay within the Dodd-Frank and CFPB rules, you don't want to do the underwriting really. You want to have someone else, because if you go through foreclosure and the judge goes, well, you did the underwriting, this seems like predatory lending. You don't want to have that in front of you, because then you might be in trouble, as they call it, and have to, forgive the loan or even pay back the borrower payments that they've made. And you don't want to do that. So we just say, use a third-party underwriter. You're going to spend anywhere from $1,000 to $2,000, depending on how complex it is, just to give you a little taste of what the cost range could be on that.
Yeah, that's something our president Jason always advises as well, is like, don't be afraid to hire that professional, because at least now things are done correctly.
Yep.
They're done right, and you want to make sure that it's secured. And that's the most important thing when you're doing mortgage notes, is make sure it's secured correctly, make sure you have the deed, make sure you have the title insurance,
Yep.
Make sure all those things are protected. And that's the best way to protect yourself. All right, next question for you. How do you find notes to buy? And is there a marketplace somewhere to shop notes?
Well, I don't know if you can read my poster board behind me here, but one of our taglines says our company's Bright Path Notes, and we say, we've got the deal flow to make your cash flow, meaning we have sources and we have inventory ourselves to sell people loans. But there are marketplaces out there. If you just Google search finding loans or buying loans, a lot of loan servicers will distribute loan sales monthly or quarterly of their investors that want to sell their loans. We do direct mail advertisements and SEO marketing as well to find seller finance notes. And so those are just kind of the round table ways. Now, if you have an in with a hedge fund or a Wall Street firm, it's a big company that deals with notes or buys REO properties, they're going to be able to sell you loans as well. But you probably have to have your foot in the door pretty far for them to want to respond back to you. People can call banks as well. Then again, you really need a good solid connection with the bank. You can't just go to Bank of America and find assets. You're going to have to go to a much smaller, much more regional, localized bank to have an opportunity to get loans.
All right. We'll move on to the next question. What is your methodology for finding properties?
Wow. That is probably the most common question that I get asked. I don't find properties, I find loans. So we'll specify it that way. That probably meant to word it that way. I look for loans depending on my capital stack that I'm working with. So if this is in my company account, I'm dealing with cash, right? So I'm looking at a property or a loan a certain way. And if it's in my retirement account, which is why, we're here talking today with New View Trust, I'm going to look at it in a different light. So we'll talk about retirement account. So I like the long-term passive income plays in my retirement account because I honestly want to set it and forget it. I mean, you saw how quickly I lost interest or I forgot about that piece of land in Florida that I had, one of my IRA accounts. It's very easy to forget about stuff, especially if you have multiple retirement accounts or educational savings account or HSA accounts, to lose track of that stuff. So I go with the more conservative play for the retirement account, meaning I'm looking for a long-term note. I'm looking for a pretty consistent borrower, and I'm looking for some protection where the collateral is going to be up here, and I'm going to be buying the note, and my cost of capital, or I'm sorry, my cost of entry here is right here on the note.
All right. Okay. Next question is, referring to your second example, where are you finding bank-owned notes for sale?
In that particular example, it wasn't a bank-owned note. If I said that, I misspoke. It's actually a seller finance note, meaning it was probably a hedge fund or a big company that gobbled up an REO at some point, and then they sold it with seller financing. That's a majority of our loans are going to be seller financing that we purchase, and we purchase for other investors as well. Not too often we run into bank-owned notes. They might be bank notes, but they've been sold 6 or 7 times till they got to me, because the different big banks are trading them back and forth to each other.
Interesting. Okay, next question is it possible to do a third-party underwriting when buying performing notes?
So you're saying if we bought a note, or you, whoever's asking this question, if you bought the loan, if you could send it through third-party underwriting? Well, you absolutely can. You just got to have the borrower's permission, because at this point, the borrower signed a promissory note and a mortgage or a land contract. So they've already got a piece of paper that says, hey, I'm good with this deal, baby. I'm signed on it and I'm paying the debt on it. If they want to go through underwriting again for you, that's up to them. So that you would have to work that out. Hopefully that answers that question, but I do get that question answered a lot. When you're buying a performing loan that's already performing, you're not as concerned underwriting the borrower specifically like you were if you're creating the loan, because you're looking at the pay history. That pay history will give you the story of that borrower, and if you're going to have a lot of challenges moving forward. And we've got a pretty good success track record of looking at pay histories, knowing if we're going to have a problem or not.
All right, we got some more good questions coming
Okay.
up here. What is the interest rate on the owner financing that you created? I think that varies, doesn't it, by state?
So that's a good question. It's kind of open-ended, because there are some rules and regulations that don't want you to charge, like 20 or 30% interest rates, obviously. The one that I did was 11% interest rate. Now, keep in mind, that's on a vacant lot, and that's for a non-owner occupied borrower, right? They're not living in a house because there's no house there, right? So the rules don't apply or don't affect me as much in that situation. And it's really low balance. So for me to have a return that is, feeds me, if you will, 11% was just what I felt was fair. Typically on low balance loans, like under probably, I'd say $50,000, you're probably very commonly going to see 8, 9, even 10% interest rates on the face value of the paper. And as you get higher in value, the interest rate is going to tick down a little bit more, because you'll find out if you run a financial calculator on these loans, if you have 11% interest rate on a $200,000 mortgage, that payment is going to be out the wazoo versus having a 6% interest rate. So you have to make it fair for them, because like we said before, Brian, we want them to have the ability to repay. We don't want them to struggle, because I don't want the property back, Brian. Especially in my retirement account, I don't want the property back, to be honest with you. I want that thing to be working like a machine, like an ATM, month after month.
Yeah, I like that strategy. Keep it passive, keep it at arm's length. If you foreclose on that property, you better be ready to, what is the word Jason says? Don't loan if you don't plan to own.
Yeah.
I don't really like that philosophy. I'd rather keep the note than have the property, and I would sell that note versus having the property 100%.
Exactly.
Can you share the underwriter link in the chat or the Q&A?
Yeah, sure.
Probably the chat.
I'll type it in there.
Perfect. All right. Got some more questions coming in here. All right. So you mentioned that your note was in a self-directed Roth IRA. My understanding is that Roths have income restrictions. Can you do this with a non-Roth self-directed IRA, and is it less profitable?
Read the beginning of
That's
that question one more time. I missed the beginning part.
Yeah. So you mentioned that example that you gave was in a Roth IRA, basically, and the person says, understanding that Roths have income restrictions, can you do this with a non-Roth self-directed IRA? And is it less profitable?
So let me rephrase the question. And Brian, you might have to answer some of this because it has to do directly with the retirement account. But I
You got it.
believe what the person is asking is, in any of those deals that I did, could I have done them in a traditional IRA or any retirement account? And the answer is yes, I could have done that. The ramifications are, do I want to pay taxes on the crop or pay taxes on the seed? So
Yep.
I choose to pay taxes on the seed, and whatever I make in the future is going to be tax free for me. It's not the wrong answer to use a traditional account and have pre-tax money and pay for this stuff. It's just you're going to have to pay taxes in the future. It's whatever strategy you want to use. Do you have anything to add to that, Brian?
Yeah, I do actually. So it doesn't matter what type of IRA you use or retirement vehicle you use to purchase these assets, like mortgage notes.
Mm-hmm.
Um, you have the ability to either defer the taxes, which means you pay the taxes later. Once you're retired, you start taking those distributions, and it's based on whatever your tax bracket would be at that time, which typically, if you're retired, you're not working, you're going to be in a lower tax bracket. In a Roth, you would pay the taxes on the contributions to the Roth, and then going forward, all your returns from your investments are going to grow tax free. So it's really up to you what strategy works best for you. And if you make too much money and you can't contribute to a Roth, there's the ability to do what's called a Roth conversion, where you have a pre-tax account like a traditional IRA or a SEP or a previous employer 401k plan, and you can convert that money into a Roth by paying the taxes on that. And now going forward, you have money, you have it in a Roth account where you can now invest and purchase these mortgage notes, and it's going to grow tax free for you. So there is still ways to have a Roth in your name, even if you exceed those income restrictions.
I want to add something to that. So a lot of people get, and we talked about a little bit about this last night, Brian, on the broadcast, is the small balance IRA is still a very powerful tool because of making contributions. So if you're able to make contributions to your IRA, Roth or traditional, do it. Even if you're buying loans with it and you're receiving cash from it, you still want to contribute to it, because the more fuel you put to that fire, it's going to grow exponentially a lot quicker too. So I would highly encourage the contribution and max it out every year that you possibly can.
Yeah, 100%. If you don't have any retirement vehicle at all created for you, call me. We'll talk about it one-on-one, and we'll figure out, if there are some options that would work best for you. And if you're just getting started, don't let that hold you back. A
Yep.
lot of people, they start somewhere. Everyone starts somewhere, even if it's a small contribution to the IRA. But at least now you have some money working for you in that tax deferred or tax-free vehicle. Just depends what type of IRA you're using. Okay, this next question is kind of a general question.
Okay.
I don't really know if we have an answer for it, but what would be the minimum and maximum ROI per year in note investments?
Well, that question is really up to you and how you buy the note. So obviously, the more discount that you buy, meaning if the loan balance is $100,000 and you buy it for $99,000, right? There is a discount there of $1,000. So your yield is going to be a little bit higher than the face value of that interest rate. So say it was a 5% interest rate. Well, obviously you're going to be making like 5 1/8 interest or yield, excuse me, on that investment. So if the interest rate is 0 that you're purchasing in, and you're paying $100,000 for that note because it has a $100,000 balance, then you're going to be making 0 interest, right? You're just going to be collecting principal payments. So it depends on the discount that you buy will effectively have your yield change. So we don't say ROI. And the reason why I say that is because there's not a return on investment until it matures. Let me say that again. There is no ROI until the investment matures. It's calculated as yield in the note investing world when we're projecting what we're going to make, right? When we have the asset mature or the loan mature, that's when the ROI can kick in, and we can annualize that as well.
Okay. And can you sell a note like before it matures if you didn't want to hold it anymore?
Mm-hmm. Yeah. For example, like that owner finance note on my first case study, I just actually sold that loan yesterday. finalized a deal yesterday on that to someone else, actually another person's IRA account.
Oh, nice.
So it hopped from IRA to IRA.
All right. Next question here. What are all the costs that incur on these types of deals?
So let's break that down. Let's start with the owner financing deal. So costs that you're going to incur, obviously time, but costs are going to be, underwriting fees, closing fees at a title company, lender's policy, owner's policy, recording the documents, boarding with a servicer. Those fees can add up, right? But you don't have to pay them all, Brian. You can choose to pay some of them. You can choose to pay all of them, and you can choose to pay none of them. You can include all these fees that you want inside of your HUD statement when you close a deal with owner financing. That's what makes it so sweet. It's added on to the purchase price as additional money they're going to have to put down. So you can essentially not really have any money in the deal for this owner financing. Not be out of pocket with this stuff. Now, sometimes the borrower is not going to be able to afford it, and that's okay, but they do need to come to the table with something, not only with a down payment, because you're providing them a premium service with premium financing.
Yeah, and that's the power of mortgage notes. What is it that Jason likes to say? Those with the gold make the rules. I mean,
Yeah.
it's kind of true to some extent, of course. I mean, you can't charge outrageous interest rates, it has to be within reason. But I mean, if you want to include custodial fees or underwriting fees or attorney fees or any of those fees in the note, and the borrower really needs that money, they're going to pay those fees. They're going to let you include those things in the note. It's really up to you and your negotiating power.
Yeah, Brian, the borrower really cares about that monthly payment amount. They really don't care that much about the total purchase price because they understand it is what it is, because that's really their only option at this point, which is why banks don't really lend below $100,000. And guess what, Brian? That's the sweet spot for note investors like ourselves, because they don't have anywhere else to go, and we can provide the financing. Now, we're, like Brian said, we're not being ridiculous with interest rate and fees. We're making it fair, but we're also setting a market value for it as well. And that's what the market is telling us is, this interest rate someone asked before, it depends on a couple of factors, but whatever the fair value is what we're going to do.
Yeah, 100%. All right, next question here. Are there typically any terms in the note that prevent the borrower from refinancing at a lower rate with a different lender?
We don't have any prepayment penalty clauses within our notes that we do. There may be reasons to put a pre-penalty payment in there if that's what you're asking. But yeah, it's really up to the lender. Like, he who has the gold makes the rules, right? That's what I think Jason was saying.
Mm-hmm.
You make the rules. You make that promissory note and mortgage whatever you want, and the borrower has to agree to it and sign to it. But you can put in there whatever you want. Sometimes on more like commercial loans, we'll do assignment of rents clauses and things like that to help protect us and make them sign, a different type of promissory note. So there's lots of things you can do that are very creative.
All right. The next question here is, why is the owner of the seller finance note willing to negotiate the note price or value with you as the note buyer?
So if you ever look at an amortization schedule, let's take $1,000 monthly payment, for example. If someone is making $1,000 mortgage payment, that first payment they make to a bank, let's say, is probably going to be $950 interest and $50 principal, right? So if they sold that loan, or that borrower had to refi within 1 month, the borrower would still owe, let's say it was a $100,000 mortgage, $99,950, and you've collected $1,000, right? So if you just look at that over time, it takes about half of the life of the note for the balance of the interest and principal in the month to be just about equal. And so all these loans are so front interest heavy that when on paper, it looks like someone would take a loss, but in actuality, they have a pretty large gain because they've collected so much interest from the borrower from all these months of payments that have been coming in before they sold it. So that's the reason why they can sell this at what's perceived as a loss. But looking at the AM schedule will help you see that.
Okay, this is a very interesting question here.
Okay,
this is more of an example. So currently, I am part of a syndication for apartment investing. Could I get out of my position by selling my portion of the investment? And when he says get out of my position, he means selling his position as a note.
So it really depends on your documentation and your agreement or your PPM that you signed. We'll have information or stipulations in there on what you can and can't do. It, I'm sure there's probably a way for someone to buy your position, because if, as long as whoever is running the syndication is okay with that, as long as they're not losing money, I can't imagine why they would mind or would care if someone else slid in their position. It's just like doing subject to deals where someone else may be paying maybe on the mortgage, but someone else is paying it for them. So it just really depends on your language of your contract. So obviously I'm not a real estate attorney on syndications, but I would say there's probably a way to do that, because you can really buy any paper. You can buy invoices and receivables and lottery winnings and NFL contracts. I mean, all this stuff that's written on paper, you can sign your vested interest over for a cash, a cash amount.
Yeah, that's pretty interesting. I didn't even think about anything like that. That's a different strategy, but
Yeah.
whoever answered that question, when you get the answer, I would love to know more about that as well. That's a pretty interesting, unique way of taking, that investment you currently have, and hopefully in an IRA, and then positioning that to, as a note. That would be a pretty cool strategy, I think. But yeah, definitely, there's a lot of paperwork when it comes to syndications, and I mean, you're gonna have to have a really good attorney, and they're probably gonna charge a lot of fees to dissect that and see if it's
Yeah.
possible for you.
We can make this all really complicated for you. And if I have a portfolio of loans and I want to get a loan against those loans, I'm pledging those loans in a hypothecation. And I can say, look, I have these loans in my portfolio and I'm getting all this cash flow. Can I borrow, let's say, $500,000 against that portfolio? And the lender looks at it and says, yeah, I can do that, because they see cash flow coming in. It's like looking at an asset, like for collateral, when you go out and get a loan.
All right, so here's a few other questions here. Other than real estate without renters, for somebody that's a beginner and they're just trying to learn the basics of, note investing, what books or podcasts or anything like that you might recommend for someone getting started?
Well, there are a lot of note investing specific podcasts and real estate investing specific podcasts and retirement account type of podcasts on how to invest in things out there. I can't really speak to which ones are the best, out there, because there's just so many out there that are really good. I would just encourage you just to listen to them. For example, like on our YouTube channel, we got a ton of free information out there just about note investing in general. And then, in the future, we are going to have some sort of classes to where people can pay if they want to, and just kind of learn some fundamentals. And there are other people that do the same thing as well. They charge to learn kind of the fundamentals of what we do in the business. So I would just encourage you just to look at different books that are specific to what you want to do, whether it's cryptocurrency or note investing or buying Arabian horses or flipping cows through your IRA. I mean, whatever you want to do that floats your boat. There's going to be a book and podcast about it. So I could probably name off a couple of my head, but I don't want to guide you in the wrong direction, if that makes sense.
Yeah, definitely. Not only that, I mean, there's resources like YouTube. There's a lot of great content on there. Seriously, Be the Bank. I was on it yesterday. It's very interactive. There's a perfect Q&A section there. There's a lot of great guest speakers on there. You can learn a lot. I would encourage anyone listening to definitely check it out. And all the recordings are there on YouTube. Just subscribe to the channel. So with that, that is the last. Oh, it looks like we might have got one more question. Let's see. Oh, no, he was just saying invest in debt. It's a book that
That's
somebody
a good book.
recommends. Invest in debt.
Book.
Have you read that one?
I haven't read the entire book, but I've read most of it.
Okay.
It's one of those where I got it at an event and I started reading it and I put it down. I forgot about it and I picked it back up and put it down.
That's kind of how I get through books as well. Yeah. Sometimes I have to reread a few pages over and over.
Yeah.
Okay, this is a longer question, but this will be the last one.
Okay.
Are there contractual protections that prevent the borrower from taking out a home equity loan and using the collateral of that security note? I am sure that the mortgages are recorded, so a bank would see that.
That's a good question, and I'm going to kind of read into how you phrase that question. I think I know what you're trying to say, and please reply back if we're not on track on the same page here. So we have a property, we have a borrower on a property, they have a loan on that property, a first lien, and say, I own that loan, I'm the bank on it. Let's say it's $100,000 property, it's worth today. And let's say the borrower owes $50,000 in this property. So they obviously have some equity built in there. If they choose to use some of that extra equity that isn't leveraged to go get another loan, they absolutely can. Me as the first lien holder on the bank, it doesn't matter to me because they're all way behind me in line with foreclosure, right? I'm in first position, so I don't care how many loans they get behind me. If someone else wants to make the loan and be in that second, third, or fourth position, that's totally up to them. So yeah, being in the first position, you're in the first position, right? The only thing that can trump you are property taxes. And in some super lean states, you can get trumped by HOAs and things like that.
So then I have a question. If somebody were to pay off that first lien and somebody has a second lien, what happens to the second lien?
Well, if the first lien got paid off, then there's still a second lien out there. If they can choose to pay off the second lien, or the second lien now gets
First position?
Be the first lien. Yeah.
That's what I thought. Okay, nice. I'm only asking because my mom holds 2 notes and she's in the second position right now, but they're close to paying off that first lien. And I didn't know what happens after that. So she becomes the first lien holder.
Yeah. Sometimes if you have a non-performing first lien and a non-performing second lien, some people will buy that non-performing second lien and just start paying on the first, knowing because there's so much equity in the property. So sometimes on higher valued properties, there's investors that do that, and the math works out well. But those are, the first lien doesn't care as long as they get paid off. They don't care what happens behind them, because like I said, in that example that I gave with the $50,000 debt, if I'm owed $50,000 on a $100,000 house, I feel really secure that I'm not going to have any issues getting my money back, because that real estate is my collateral. And if I had to take it back, I'm well protected. So
nice. All right. So everyone listening, if you want to download a free e-guide, you can text 484848. That's the number. Text capital SDIRA. Please include your first and your last name. You can get a free self-directed IRA e-guide. My direct contact information, if you have questions on self-directed IRAs, that's my direct phone number, 407-519-9172. And you can also reach me at newviewtrust.com. There's a little chat bot in the bottom corner. If you leave us a message there, we'll get right back to you. Or you can email me directly at B for Brian Martinez at newviewira.com. Thank you again, Justin. I really appreciate, those case studies. Those are great, realistic examples of what it's like to own notes in an IRA. I hope everyone enjoyed the presentation. I know they did. This will be posted on our blog, so feel free to share it with any friends, family, or anyone in your network that would like to rewatch this. It should be posted before the end of business day tomorrow. So thanks a lot, everyone, for joining us again, and we'll see you next time.
thanks, Brian. Appreciate you guys having me on.
Thanks. Have a good day, everyone.